At the date of acquisition, shares in Pedantic had a market value of $6 each. Below are the summarized draft financial statements of both companies. So I can see revenue, cost of sales, I can see gross profit, I can see operating costs. I can basically see the income statement there. And then I can see the statement of financial position as at 30th September 08. So the SOF has been given. The SOF has been given there. Yes. So what do they want us to do? They want us to do something very easy. They want us to prepare the consolidated statement of profit or loss for Pedantic for the year ended 30th September 08. And then lastly, to prepare the consolidated statement of financial position for Pedantic as at this year, September 08. Now, if I'm the one doing this question, I'll end up getting so many marks without even knowing what I'm doing. Why? Because of the concept of low hanging fruit. Step number one, give us the group structure. So step number one, give us the group structure. So we have a company here called Pedantic. Pedantic acquired 60% of a company here called Sophistic. So we acquired 60% of Sophistic. We acquired 60% of Sophistic. Now, ladies and gentlemen, you guys are bright students. Could you kindly advise me? With this kind of shareholding in Sophistic, Sophistic will become who to Pedantic? 60%. 60%. So automatically Sophistic becomes a subsidiary, because I mean, this is more than 50%. It automatically signifies that Pedantic is in control of Sophistic. So you guys are very bright. This is a subsidiary. This is a subsidiary. This is a subsidiary. Now, if it's a subsidiary, remember, I'm required, if this is a subsidiary, of course, this is the parent company. So remember now here, I'm required to consolidate financial statements of who? The subsidiary and the parent. Consolidation means what? Putting together. Consolidation means what? Adding. But as I add, I must always take into consideration the period that I stayed with this subsidiary in the financial year. So we want in this case here to mark the date of acquisition. Please write this in full. Date of acquisition, date of acquisition, date of acquisition. And then we have the date of the financial statements. Write this in full. The DOA and the DOF. Write this in full. The DOA and the DOF. The DOA and the DOF. So the moment I have this date of acquisition and the date of financial statements, I'll go to my question and read what this examiner wants me to do. For those students who have just joined us, I would want to make some announcement here that I would want to use this particular question, basic question of group consolidation, to enable us understand the consolidation concepts for us to be able to jump into this great question that came last semester, right? Remember, this is not your usual class where we begin by, no, this is a special revision class. It's a special revision class. It's a special revision class. Right? So after this, we shall be able to go to the past paper. So please put your eyes glued on the concepts here. Ears open. Very important. So we have the date of acquisition, DOA, the date of acquisition. What do we have here? The date of acquisition that this examiner has given us, ladies and gentlemen, the date of acquisition that this examiner has given us is 1st of April 08. On 1st April 08, Pedantic acquired. So 1st April 2008. So we have here 1st April 08. And then we go to the date of the financial statements. So the date of the financial statements, the date of the financial statements, the date of the financial statements given here, look at this. The date of the financial statements. So we have 30th September 08, 30th September 08, 30th September 08, 30th September 08, 30th September 08. So, ladies and gentlemen, could you kindly count for me from the date we acquired this subsidiary to the date of the financial statement, how many months do we have in between there? I know very many ladies, I don't trust them in terms of counting months, dates. I don't trust them. You'll see most of them will get wrong. Men will always get dates correct. I've never seen any man counting these months wrongly. Right? You can see, okay, why saying 6? Right? All right. Penina 6. Even ladies today, they are getting this thing correctly. Right? What they have done, they have counted, the whole of April. So we have April, May, June, July, August, and then September, the whole of September, 6 months. So in the financial year, since we acquired this subsidiary to the financial statements date, ladies and gentlemen, we have got how many months in between there? We have got 6 months like that. 6 months like that. We've got 6 months like that. Thank you. You guys are bright. Thank you so much. Ladies and gentlemen, listen and listen to me very well. When you look at, for example, the income statement given, the income statement given here is for the whole year. Is for the whole year. The income statement, profit or loss statement given here is for the whole year up to 30th September 08. I've got no problem with pedantic. Pedantic is the parent in the group. So pedantic, I stayed with the pedantic for our whole year. Pedantic was a member of the group for our whole year. But you see, sophistic was a member of the group for how many months? 6 months alone. It means that I must go to the financial statements. I must go to the income statement of sophistic, which is a whole year income statement and a time portion. When I'm consolidating, when I'll be adding together these revenues, these expenses, I will be taking expenses, for example, of the parent company for the whole year, plus expenses of the subsidiary time apportioned, times 6/12. Now, the moment I've known that this is what I'm supposed to do, ladies and gentlemen, now I can come right away. I'll not do much workings in between here. I will not do much workings in between here. What I'll need to do straight away is to come and write the name of the parent. The parent is called, the parent here is called who? The parent is pedantic. The parent is pedantic. So I'll call it pedantic group. Pedantic group. Pedantic group. And then I have here consolidated, 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 profit and loss statement, consolidated statement and loss as profit and loss statement for the period ended. Of course, how to write that very well. Right? So first of all, I'll do this. I will do this. I will do this. I'll do this. So I'll start consolidating right away. I'll start consolidating right away. And to consolidate is the easiest thing really. And this is a topic that we must really appreciate. Look at, for example, what happened last semester. They gave us group consolidation, 20 marks. And then they gave us group cash flows, another 20 marks. So if you don't understand this topic in AFR, trust you me, it will be disastrous come August. And if you want to pass, ladies and gentlemen, this particular paper very easily, ensure that you really appreciate group consolidation inside, outside. The moment you do that, group consolidation and group cash flows, they're different topics, but of course related. The moment you understand the two topics very well, you'll never go wrong. You'll never go wrong. So don't read even the additional information. For now, start your consolidating process. I can see a student asking, which question are we doing? It's a simple question that I gave you. It's here. It's in your group. So then we start with the first one. So I'll pick revenue. Revenue, I'll take the one of the parent, the whole of it, plus the one of the subsidiary, but time apportioned, time apportioned, time apportioned. So mention there revenue. So first of all, you copy everything here. You copy everything. You copy everything the way it is here. The way you are seeing those items of the P&L given there, you copy that. Exactly everything. Everything. So I have revenue that I'm copying. I have revenue there. I copy like that. Revenue. The next item is cost of sales. After cost of sales, the next item is gross profit. Gross profit. After gross profit, the next item is operating expenses. You copy like that. Because really there is nothing new you are bringing on board here. You are simply consolidating, you're simply adding together. So operating expenses, then we have profit before tax. Profit before tax. We have profit before tax. Then we have the income tax expense. Income tax expense. Income tax expense. Income tax expense. And then we have profit for the year. Profit for the year. Profit for the year. So profit for the year, you simply copy like that. That is the first thing that you do when you are doing a consolidated profit and loss account. Is it possible, ladies and gentlemen, that the moment you reach there, is it possible for you to signal me and tell me, yes, why for yes, we've been able to copy this income statement, profit and loss statement items as they are given. The moment you reach there, simply tell me why for yes. Thank you so much. Thank you so much. Thank you so much. So let's start consolidation process. It's the easiest thing ever. So what we are doing here, if it is revenue, I will take the one of pedantic, which is the parent. So I'll take 85,000 plus the one of the subsidiary. The one of the subsidiary is 42,000. But now these I have to say times 6 over 12. Times 6 over 12. So what I'm doing, again, I'm copying everything here. The parent, I'm taking everything. And then the subsidiary, I'll be multiplying the ones of the subsidiary with 6 over 12. Kwenda chini kabisa. Kwenda chini kabisa. And don't pick your calculator. You're still trying to lay the format. You're still trying to lay the format. You're still trying to lay the format. So what I'm doing is to take the figures of the parent, the whole of them, plus the ones of the subsidiary, times 6 over 12. Nimetoa 6 wapi? Nimetoa 6 wapi? Kumbukeni, hatukukaa na hii subsidiary for a whole year. In the financial year, tulikaa na hii subsidiary for how many months alone? 6 months alone. Tulikaa na hii subsidiary for 6 months alone. Utapata mwanafunzi ati anakuja hapo kwa parent anasema times 6 over 12. It's only the figures of the subsidiary you can time a portion. Right? So kazi yako ni copy kwenda chini woye, abracadabra, very first, abracadabra, very fast. What do we have there? Cost of sales 63,000. Cost of sales 63,000 plus, ladies and gentlemen, the next one, which is 32,000, times 6 over 12. Gross profit, usikopi gross profit, utakuja ku adjust baadaye, utasubtract baadaye. The next item, ladies and gentlemen, is the operating expense. Operating expense, I can see 8,300. Operating expense, I can see 8,300 plus 5,600 plus 5,600 times 6 over 12. Times 6 over 12. Tuko na profit before tax, where profit before tax is a function ya subtract. E profit before tax, abracadabra, profit before tax, nitakuja nichukue gross profit minus this operating expense. So hii unawacha dash. Unaona unachukua the next item. The next item hapo inaitwa income tax inaitwa income tax expense. The next item inaitwa income tax expense. So income tax expense 4,700 and then 1,400. Income tax expense tuko na 4,700 plus 4,700 plus 1,400. So this 1,400 has to be time apportioned times 6 over 12. Times 6 over 12. So I would want to know, ladies and gentlemen, whether all of us, we've been able to reach here where mwalimu has reached. Tumefika kweli hapo ama bado? Hivyo tu. Wengi hawajasema yes. Times 6 over 12. Paka mwisho. Thank you so much. Now from there, ladies and gentlemen, before I go to my balance sheet, I know that there are adjustments of the income statement. You great people, what kind of adjustments do you expect in the income statement whenever I'm doing group consolidation? What kind of adjustments do I expect? Because it's a matter of you can even cram. What kind of adjustments do I expect? Thank you very much. Annette anasema hapa tuko na unrealized profits on stock. Thank you very much. Any other adjustment in the income statement? Intercompany sales. Intercompany sales is very important. Intercompany sales, actually we should even begin with that one. Intercompany sales. any intercompany trading, like what Stephen is telling us there, intercompany, these companies are serious relatives, which are not supposed to trade with each other. These are serious relatives. This is like, for example, myself here with my son. If my son comes and, for example, buys something from my shop, there is no way I'll take even money from him. So any intercompany sales, remember it's called intra-company, it's internal. Intra-company sales must be subtracted group sales and the group cost of sales. Group sales and the group cost of sales. Anytime you're told anything to do with internal company sales, it's fake sale. So come and subtract it. So look for information mentioning anything to do with the internal sales. Anything to do with internal sales, look for that particular statement talking about internal sales. You can see note number 2 here. Sales from sophistic to pedantic in the post-acquisition period were 8,000. You know, even how you read these terms is also important. It's a skill you need to learn. Remember your figures up here. Remember, my friends, that your figures up here are in terms of dollar thousands. So when I read these figures down here in the notes, I must chop the 3 zeros. The most important thing that I'm supposed to be picking is that sophistic and pedantic did some business and they were able to sell goods worth 8,000 between themselves. That is the internal sale. Internal sale, there is no way, 2 ways about internal sale. Internal sale must always be deducted from the group sales and from the group cost of sales. So first of all, that note, are we together up to there? Are we together first of all up to there? I would want feedback from you people. Are we together up to there? Yes. Those yeses have started now becoming in trickling, small, few. Great. Unakram. Ukisikia internal company sales, any intra-company sales must always be subtracted from group sales and from group what year? Cost of sales. That is so important to me now. Ladies and gentlemen, I've been able to finish this concept of intra-sale. Riding on this intra-sale, what do you think will be the next step? Still riding on the intra-sale. You know, group consolidation itaki kufikiria kwa mtihani. Group consolidation kama mimi nafanya haraka sana sababu najua group consolidation kuna ile pattern nimejua. So kama nimeshangoa intra-sale, what do you think will be the next working? UPS. Thank you very much. Let's call this UPS. So we have here the unrealized profit on stock, UPS. Please, you can also call it URP. You can also call it URP. Not group holdings, hiyo umeenda mbali. Kwanza hii, ukishangoa internal sales, unajua kuna unrealized profit on what? Stock. Kuna unrealized profit on stock. So, and I hope you guys have been able to write this in full. It's called unrealized profit on what year? On stock. It's called unrealized profit on stock. So if you've been able to write this in full, could you be nice to me by coming and giving me, ladies and gentlemen, the formula? Who is able to remember the formula of calculating UPS, ladies and gentlemen? Who is able to remember the formula of calculating UPS? Who is able to remember the formula of calculating UPS? Who is able to remember the formula? I can see what Betty is telling me. Thank you very much. Betty anasema that this should be profit margin times the famous RIS. Very important, especially for ladies who are called RISPA. If you're called RISPA, inakuwa rahisi sana. Profit margin times RIS. To get UPS, we normally take profit margin times RIS. Now, ladies and gentlemen, advanced FR classes, they are supposed to be 3, not 2. And I looked at how the timetable is. I'm not able to fix any third class. over the weekdays or even over the weekend. So I don't know whether Jesus Christ himself can touch you people to accept to fix our third class early in the morning, one of the fine days. Like how 4 a.m. We need how many classes for AFR? Three. And because we can't have any fitting here, I would want you guys here to discuss maturely. It's about sacrifice. Museme mwalimu introduce the third session, for example, tomorrow at what time? Atakani 4:30. So long as it fit 1.5 hours, more than 1.5 hours, to really be good. Reason takwambia reason remaining intra sales. Reason takwambia risk inamaanisha remaining intra sales. Inamaanisha remaining intra sales. So between Monday and Friday, which day is good? Ile stock imebaki, huyu kijana najua sana maneno. Remaining interest sales, ile stock imebaki. So between Monday and Friday, which day in this case here should we do? Edgar, Mondays are not very good for very many people. Monday morning, Monday may not be the best. I'm 100% sure. We don't have to start this week. Don't fear saying tomorrow. We can say we start from the other week. But at least we must have 3 sessions, because a topic like group consolidation, sifai nikianza kufunza nikae kwa group consolidation sana. Inafaa like maximum 2 weeks. Nimeshamaliza this normal one, nimefanya foreign subsidiary, nifanye step acquisition, nifanye disposal. That is it. I can see what RM is suggesting. Saturday morning. I don't know whether Saturday will be very good for the SDAs. Okewa is saying Wednesday, and Okewa, I can see what Okewa wants. You would want Wednesday, and we start this Wednesday. Saturday. Tumalize topic kwanza. Nuna muongei sasa. Mtaanza kuongea kwa WhatsApp. Which will be very bad. So mwingine amesema Wednesday, kuna mmoja amesema mwalimu, why can't we have it on Friday early morning? So pata potea within 1 minute, which side wins? So now we are debating between 2 days. We are debating between Wednesday and Friday. Wednesday and Friday. Wednesday wins. Friday, Lucy. Wednesday, 4 to 5:30. To agree on the day kwanza, masata agree. Friday. Thank you very much. At least tumesha fanya nini? Tumesha kubaliana masiku. No, Saturday hapana sababu ya SDA students. Saturday hapana, you also don't want to fight with God. Saturday tumekataa. So we zero down to Wednesday stroke Friday. We shall continue with this debate again. Nikienda break, ilikuwa ni break time yangu. So tumesema hapa ni profit margin times remaining intra sales. Profit margin times remaining intra sales. So here I will be looking for 2 components. I'll be looking for the profit margin, and I'll be looking for the remaining intra sales. So ladies and gentlemen, here we have this question here. On the same line, we are told Sophistic made a markup on cost of 40% on these sales. This examiner wants to fix me down, but I'm very clever. He knows for sure that in group consolidation, we normally use profit margin. That one the examiner knows. But now he's going ahead to give us a markup. He has given us profit markup. So with profit markup is 40 over 100, 40%. I must change markup to margin. Group consolidation, we always use margin. So in that case, ladies and gentlemen, then, what will be the profit margin? I would want to keep silent 1 minute. And then I see these guys here, whether they'll be able to get this correct. Profit margin will be 40 over what? 40 over 140. Thank you very much. Margin has got a bigger denominator. Margin has got a bigger denominator in comparison to markup. In comparison to markup, margin has got a bigger denominator. So what I'll do if it has got a bigger denominator, I'm going to add. So I'll come and talk over 100 plus the numerator of 40. So 40 over 140. 40 over 140 like that. Ah, great. You can also decide to chop to 2 over 7. So what have we learned out of this conversion? I know somebody has not yet learned these. Assuming, ladies and gentlemen, that profit margin is 2 over 10. What do you think in this case here will be the value of the profit markup? If margin is 2 over 10, markup itakuwa ngapi? Will it be 2 over 8 or 2 over 12? Millie. Millie has changed her mind very fast. And vile kunaonekana vizuri. So ukisikia margin has always a bigger denominator. If I'm going to mark up, I will be subtracting. I'll be subtracting. But the most important thing, ladies and gentlemen, for this particular class, in most cases, this examiner will give you profit markup. If he gives me profit markup, then straight away to get profit margin, what will I do? I will have to inflate the base. I'll have to make the base bigger to get the margin. Margin has a bigger base. So we are saying here that the profit margin is okay. How about this remaining intra-sales? The remaining intra-sales that we have, ladies and gentlemen, here, we are told Pedantic had sold $5,200 of those goods by 30th September 08. Listen to me very carefully. These goods were obtained from Pedantic to Sophistic. 8,000. Now, if these goods, Sophistic, our subsidiary, was able to sell all of them by the end of the year, then there would not be a problem to do with unrealized profits. Ladies and gentlemen, if goods flow out of our organization, out of our parent and the subsidiaries, they flow to third parties, then we realize that profit. But if we take, ladies and gentlemen, goods from, for example, a parent to a subsidiary, or from a subsidiary to a parent, and then some of those goods still remain where? Within the group as unsold. It means that the party that had sold these goods to the other, like subsidiary, for example, sold the parent, this party recognized some profit. And that profit is fake. Why is it fake? Because it is still within what year? Those goods are still within the group. IS2, International Accounting Standard 2, tells us that stock items should never have profit in them. Stock items should be carried at what year? At cost. Stock items should be carried at cost. Stock items should always be carried at what year? Of course, it's cost, not net realizable value, but for group consolidation, it's cost. So listen to me very well. So the remaining intra-sales then will be 8,000 minus 5,200. Because they were able to sell goods worth this amount. So then what figure are we able to get here, somebody? 8,000 minus 5,200 gives me what figure? 2,800 is the REES. 2,800 is the REES. 2,800 is the REES. So for that matter, to be able to get, ladies and gentlemen, my UPS now is a walk in the park. The UPS will be 40 over 140 times, ladies and gentlemen, times our REES, which you guys gave me a figure of 2,800 like that. So could you kindly give me this unrealized profit on stock? So the unrealized profit on stock, or nearly 800. The unrealized profit on stock, unaniambia ni 800 Kenya shillings, or other dollars. So could you kindly tell me now the treatment of these in the group financial statements? What am I supposed to do with this 800 in the group financial statements? What should I do with this UPS? Less cost of sales. Are we supposed to subtract from cost of sales really, or add? Remember, you less from sales, no. They're starting to talk nice things. We have been able to get UPS. What do we do with this UPS? This is something that has to really stay somewhere in my memory. In my memory, that UPS must always be added to cost of sales and subtracted from inventory in the statement of financial statement. In the statement of financial position, I mean. What I'm saying is that UPS, thank you so much, this 800, UPS will be added to cost of sales, in P&L, and subtracted from inventory in the soft statement of financial position, like that, in the statement of financial position. If I were you, this is what I would have memorized these with that. Anytime we get UPS, ladies and gentlemen, UPS must always be added to cost of sales and subtracted from inventory in the statement of financial position. Now, first of all, can I rub this section? Have you taken this section down? Have you been able to take this section down? Yes. Now I can see Paul lifting up his hand. So before I give him a chance to ask a question, I would want in this case to explain this thing further a little bit here. Listen, Paul, I'm giving you a chance to talk. Listen, ladies and gentlemen, listen here. How do we normally get our cost of sales? We normally take opening stock. Assuming opening stock is 10, and then you add the purchases. For example, of 20, and then you less closing stock. Say of 8. So then this will be 30. 30 minus 8 is 22. So then this 22 happens to be your cost of sales. The 22 happens to be your cost of sales. The 22 will be your cost of sales. The 22 there will be your cost of who? Your cost of sales. The 22 there will be your cost of who? Your cost of sales. The 22 there will be your cost of sales. Now, ladies and gentlemen, listen to me very well. What if you come and discover that your closing stock was overstated by 2? If your closing stock was overstated by 2, there are 2 ways of doing this correction. If it was overstated by 2, there are 2 ways of making this correction. I can come and subtract this 2 here. So that now the correct position will be 10, 20, and 6. Assuming this was overstated by 2, and we have discovered, and we know the value of closing stock. So could you kindly give me this figure? 10 plus 20 minus 6 gives me what, somebody there? 10 plus 20 minus 6 gives me what figure, somebody? They're not talking to me. We shall end this class now. I'm joking. 24. This is one of the ways you could use to correct that mistake. But you see, according to published accounts, you'll not be having closing stock with you. Published accounts, you'll only be given cost of what here? Cost of sales. And that is why we are told, ladies and gentlemen. That's why we are told here. Because I'll only be having a cost of sale, which is 22. This is what they'll do. They'll only come and give you the cost of sale is 22. The cost of sale is 22. And then they'll ask you to do an adjustment. One thing you're supposed to know, whenever closing stock is overstated and you want to make an adjustment, what you need to do is to come and take the original cost of sales, which is 22, and then you add that overstatement in the closing stock. You add. So 22 plus 2 gives us what here? Sample 20? 24. 24. Listen, I would want to even explain this better. Listen. Ladies and gentlemen, listen here. If this closing stock is inflated, if it's bigger, what effect will it have, given that you are subtracting it when calculating this cost of sales? What effect will it have on the cost of sales? It's an inverse relationship. When, ladies and gentlemen, you overstate the closing stock, automatically you minimize the cost of sales. When you overstate, because you're subtracting, when you overstate, when you make this bigger, the cost of sale in this case here becomes what here? Smaller. You reduce it. So anytime you are told that there is a UPS, UPS tells you that your closing stock was overstated. The closing stock was overstated. When the closing stock is overstated and you would want to make good your cost of sales, you add back. I don't want you to get into this science. You cannot win with this kind of science. The science that will win over any other science is the one of cramming. You know that the moment you get UPS, what do? Add to cost of sales, and the same UPS will be subtracted from my group what here? Inventory. What does that mean? If I'm the one doing this exam and I happen to be having this question paper, ladies and gentlemen, if I'm the one doing this exam and I happen to be having this question paper, I will straight away go to my, I wish I had something here called in inventory. They don't have. Everything is consolidated under current assets. So I'll have to remind myself. I'll simply come here next to Sophistic. I say minus 800, so that I'll be able to remember when I go to the statement of financial position, I know that I'm supposed to be subtracting 800 from my inventory now, which is found under current assets. So, ladies and gentlemen, what have we said about UPS that you will never forget? What have we said about UPS that you'll never forget? What have we said about UPS that you'll never forget? Forget about this science. What is that take home about UPS? The unrealized profit here that you'll never forget. Add to cost of sales. I love that. Less from inventory. Thank you so much. So you'll come in this case here to the cost of sales. I will not subtract like Beatrice told me. No, I know. I appreciate, ladies and gentlemen, that UPS will always be added to who? Will always be added to who? To the cost of sales like that. Great. Now you are doing very well. I know the next thing that I will need is depreciation of plant, depreciation of PPE. I know, I've mastered this thing for so long. I know that depreciation of PPE will affect my cost of sales. Depreciation of property, plant, and equipment will affect my what here? My cost of sales. The other thing, ladies and gentlemen, that will be quite important for me to look for, although this I'll do later, is the impairment of goodwill. I need this. Impairment of goodwill. I need this. Now, ladies and gentlemen, let's then continue reading the notes. Let's continue reading the notes. So we are told here, note number one, that at the date of acquisition, the fair value of Sophistic assets were equal to their carrying amount, with the exception of an item of plant. So that concept of PPE is now coming, which had a fair value of $2,000 in excess of its carrying amount. It had a remaining life of 5 years at the date of acquisition. Straight line depreciation is used. Sophistic has not adjusted the carrying amount of its plant as a result of the fair value exercise. I love this. So what I'll do, using straight line method, I'll first of all compute this depreciation. How I wish I had a bigger board. I'll come and compute. Ladies and gentlemen, using straight line. I've remembered. There was a Paul who was supposed to ask a question. I'm so sorry. Sorry. There is a Paul here. There is a Paul. Let me look for him. So Paul, please unmute yourself. Please unmute yourself for you to ask a question.
Actually, Mwalimu, you have answered it.
Oh, I've answered it. Great.
With the explanation you gave after.
Okay. Now, so here we are. Ladies and gentlemen, here we are. So we would want to compute depreciation per annum using a straight line method. Is there somebody who can try writing for us the formula, straight line formula of computing depreciation per annum? I know initial cost minus any scrap all over useful life. Here we shall not use that. Here what we shall do, we shall come and take the revaluation amount, all over rule, where rule is remaining useful life. You take the revaluation amount all over the remaining useful life. Revaluation all over the remaining useful life. Revaluation all over the remaining useful life. This question tells us that we have an item of property, plant, and equipment. The difference between carrying amount and the market value, when we brought in the valuer, the difference between the carrying amount and the market value is 2,000. 2,000. All over the remaining useful life, which is 5. Listen to me very well, ladies and gentlemen. What are they telling us here? What they're telling me, ladies and gentlemen, here is this. At the date of acquisition, the fair value of Sophistic assets were equal to their carrying amount, with the exception of an item of plant, which had a fair value. Fair value is the same as market value. Fair value of $2,000 in excess of its carrying amount, meaning that the fair value, meaning that the market value was higher. So when the market value is higher, that is a revaluation upward. The book value is smaller than the fair value. So of course, if the fair value is more, the valuer is telling you to increase your book value, increase your book value. So it's a revaluation upward. It's not a revaluation downward. This is a revaluation upward. Why is it a revaluation upward? Because we are told that the fair value was in excess. The fair value was higher, right? And then they have come here and told us, ladies and gentlemen, they have come here and told us, that it had a remaining life over how many years? Over 5 years at that date. So divided by 5. So then, ladies and gentlemen, 2,000 divided by 5 gives me what figure? 2,000 divided by 5 gives me what figure? 2,000 divided by 5 gives me 400. 400 times 6 over 12. Is there someone who can tell me why I am multiplying this thing with 6 over 12? Is there somebody who can tell me why I'm multiplying this thing with 6 over 12? Remember that this asset belongs to who? The subsidiary. A subsidiary that we stayed with for how many months? Don't forget, the difference between the door and the DOF was 6 months. Don't forget that. Remember, this is depreciation for a whole year. The 400 you gave me is depreciation for a whole year. And yet we stayed with this thing for 6 months. So then this gives me 200. You guys are right. Now, so then what do I do with this depreciation? Thank you very much, David. I've been able to get a depreciation that was not factored in my books of accounts, which I would want to bring to my books now. I would want to bring this to my books. Eli, thank you very much. I would want to bring this 200 to my books. How do I bring the 200 to my books? Where should I slot it? Where should I slot it? Where should I slot this? Very good, Betty. Betty ameniambia ni PPE. And somebody alikuwa ameandika huko juu vizuri sana zimeenda mbio akasema ni cost of sales. There are two accounts that will be affected here. The two accounts that will be affected will be the cost of sales and then number 2, PPE. Remember what you were taught in financial accounting, CPA section 1. You are told that depreciation of all those assets which are used for production. Depreciation of assets used to produce goods will always be charged under cost of sales. It is the only part of depreciation that falls under the direct, it's a direct expense. That expense that goes direct to production. Goods, in this case, are to be sold. Goods to be sold. We don't want to get into those semantics, ladies and gentlemen. We don't want to get into those issues that may easily confuse us. This is a property, plant, and equipment item. It's a property, plant, and equipment item. We know that depreciation of PPE must go to cost of sales. Shetani asikudanganye. Hii unakujanga unaongeza. Unasema plus what? Plus 200. Unaongeza plus 200. So if I were you, ladies and gentlemen, there is one thing that I would have really crammed here. That depreciation of PPE shall be added to cost of sales. I'm insisting property, plant, and equipment. Great. So plus 200. And then, of course, these other 200, or the 200 depreciation, I'll take to the statement of financial position. I'll go to the property, plant, and equipment and subtract 200. Where am I subtracting this? Let me write this somewhere very well, that depreciation shall be added to cost of sales. Depreciation shall be added to cost of sales. Depreciation, add to cost of sales less from PPE. So in the income statement, it's a cost. In the income statement, it's a cost. In the statement of financial position, it's a loss of value. It's a loss of value. So if some of you have been able to print this paper so that we don't forget, if some of you have been able to print this paper so that you guys don't forget, could you kindly go to where you are seeing a PPE? Just mention somewhere here. Just mention somewhere here, minus 200, so that we don't forget. Mention somewhere here, plus 2,000, minus 200. Remember, the revaluation upward is an increase in value. The 2,000, first of all, will be added here. You say plus 2,000 minus the loss, minus the depreciation of 200. Just write like that. Tukienda kwa statement of financial position, it will become very easy. Great. So let's go to, so now we are through with note 1, note 2. Note 4. Note 4 is all about intra-group receivables and the payables, intra-owings. That will not affect us here. Note 5. Pedantic has a policy of accounting for NCI at fair value. Fair value of NCI, that will not affect us at all in the income statement. So that is it. So in the income statement, could you kindly now give me these figures? I hope my board will be able to accommodate this. Now we are through. Now your work is to come and take your calculator. You say it 5,000 plus 42,000 times 6/12 minus 8,000. You give me a figure, I write. The first figure to write is how much? The first figure to be written is how much? The first figure to be written is how much? The first figure to be written is how much? Aha, so Nimrod tells me mwalimu 98,000. Thank you so much. Jackie pia amepata 98,000. Thank you. Great. 98,000. Thank you so much. How about the cost of sales? How about the cost of sales? How about the cost of sales? Cost of sales. Jackie anasema ni 72,000. Subtract for you to now give us the gross profit. Subtract for you to give us the gross profit. Subtract for you to give us the gross profit. Subtract for you to give us the gross profit. Subtract for you to give us the gross profit. 26,000. Thank you and thank you very much. Now, from ladies and gentlemen, how about our operating expenses? Please ensure you're using your body mass very well. This 6/12 is only affecting this. It doesn't affect this. Right? So 8,300 plus 5,600 times 6/12 is giving us what figure? Jackie, 11,100. 11,100. Thank you so much. So then subtract that for you to be able to give us the profit before tax. Subtract that for you to be able to give us the profit before tax. 26,000 minus 11,100 will give us what figure? 26,000 minus 11,100 will give us 14,900. Go ahead and give us the income tax expense. Income, I don't get what you have said. Sorry. Yeah, please ask as many questions as possible. Fair value, okay. You see, thank you very much. When you are acquiring an asset, we are not experts ourselves, right? We are not experts ourselves. You must bring in a valuer. So the valuer will come and tell you, hey, this asset in the books is kept, say, at 14,000. This is the book value. Book value, also called carrying value. And then now we have the fair value or the market value. The fair value or the market value. So fair value is 16,000, for example. So you can see in this case here, basically, this guy is telling us, hey, your asset is understated. Please revalue it upwards. So the revaluation in this particular case will be 2,000. So when you value this, right, revalue upwards 2,000, what do? You go to your book value, the statement of financial position given the asset there is understated. So you add the 2,000 and then thereof, you'll be able to subtract the depreciation in this amount, which we got as what here? As 2, but we'll come to that later in the statement of financial position. We'll come to that later in the statement of financial position. So that is it, ladies and gentlemen. Great. So from there, could you kindly give me this income tax expense? What figure do we have? Income tax expense, what figure do we have? Income tax expense, what figure do we have? 5,400. Thank you very much, Jackie. So subtract now here. You take this minus this. You give us profit for the year. You give us profit for the year. Profit for the year. Profit for the year. Profit for the year. So profit for the year. Inakuja ngapi? Profit for the year. Inakuja 9,500. Now, ukishafika hapo, ladies and gentlemen, please double underline. Never continue with this other process of that it's attributable to NCI. No. That does not earn you any mark in CAS level. Hiyo imetosha. I showed you the marking scheme. I'll again show you the marking scheme here today. That will not earn you even a single mark. We ikifika hapo, enda straight away kwa consolidated statement of financial position. Enda kwa consolidated statement of financial position. So are we together first of all up to there? Are we together first of all up to there? Are we together? Are we together? Great, 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 great. So unakuja hapo unaandika kwa furaha. Kwa furaha unaandika pedantic group. Sasa, with my experience of teaching this area, advanced AFR, group consolidation, I know what disturbs very many students. Whenever these students here go to these exams, shortcuts, they'll take a lot of time doing this question. Unakuta mwanafunzi anafanya question 1 group consolidation, 1.5 hours. Group cash flow, a whole hour. So examiner posema 30 minutes remaining, this student has only done how many questions? 2, of which you're not even so sure of getting everything in those 2 questions. That is why you get so many students failing in this paper. Group consolidation, you're supposed to have everything at your fingertips so that within 40 minutes, you should be through with it, right? And if you're not through with it, ikifika tule 40th minute, hujamaliza mpaka mwisho, wachana hiyo swali enda kwa swali ingine. Because again, with advanced financial reporting, exam technique is very important. Exam technique is very important. Kama una exam technique, utakuwa unanyoroshwa sema, unapata mwanafunzi ameanguka AFR 5 times. No. The exam technique. What are the low-hanging fruits? How do I harvest these low-hanging fruits? Niweza kusonga mbele. So kama hapa nikija katika, naandika title, pedantic group, consolidated statement of financial position as at that particular date given there. Una underline. So kisha underline, wewe kazi yako ya kwanza una copy ile format. Bila kuogopa chochote na copy your format. Kumbuka, as you are copying like that, most of your colleagues who are doing this paper at that level are staring at the ceiling board. You're not writing anything. You're miles ahead. Unakuja hapo na copy vile iko exactly easy. Una copy kwanza vile ziko exactly word by word. Vile iko hivyo, unaandika assets. Non-current assets. Great. Tuko na property, plant and equipment. Great. Tuko na current assets hapo chini. Nazaruka space moja kuandika goodwill. Hata ukiwacha kuruka, wewe andika tu vile iko. Andika kwanza vile iko. So andika current assets. Hapo chini naona kuna kitu imeandikwa total assets. Andika namna hiyo, total assets. All right. So for total assets, unaenda kwa equity and liabilities. So equity ya kwanza pale ni share capital. Ya kwanza hapo ni share capital. Ya pili hapo ni retained earnings. Sababu nimeanza kuzoea, najua hapa katika equity lazima ni introduce something new called non-controlling interest. Namandikia hivyo. Hii nimezoea sasa, nimeanza kuzoea, nimeanza kupata uzoefu. Namwandikia non-controlling interest. Naruka hapo namwandikia non-current liabilities. Unaandika mbio. Haitaki mchezo. Wengi wanaanguka kasneb simply because of what here. Hawajui kuandika vitu mbio. So non-current liabilities kuna 10% loan notes. 10% loan notes. Alafu kuna current liabilities. Current liabilities like that. Haya, kwanza niambie kwa usha copy this general structure paka chini. Copy the general structure paka chini namna hiyo. Jackie amecopy haraka Jackie. Betty, yes. Great. Mary, yes. Thank you so much. Sasa unaanza madoido pole. Unajua kama uko na subsidiary, si lazima kuwe na goodwill. Kama tuko na subsidiary, lazima tukue na goodwill. So katika these non-current assets, unaweza kuja tu mahali popote hata kama ni kusqueeze, lazima utakuwa na goodwill. Unamjazia hivyo. Madoido tu, hata maybe utaifanya working yake. Madoido tu, kisha mwekea goodwill hapa, mwekea NCI, umeanza kumshtua. Anajua straight away sasa hapa anadili na mwanafunzi mwerevu. Haya, tunashika hii abracadabra. So abracadabra, ladies and gentlemen, abracadabra, what do we have here? Abracadabra. So abracadabra, this is what we have. Unaanza kukopi tu kwenda chini. Sasa abracadabra, uko na property, plant and equipment. Unasema 4600 plus 12600. Wacheni sana uulize swali. Hapa kwa statement of financial position, sisi huwa tunafanya quality time apportionment. Huwa tunafanya quality time apportionment kweli? Woye waniongeleshi. Mbona hatufanyi time apportionment? Mbona hatufanyi time apportionment? Mbona hatufanyi time apportionment? Please give me an answer, good answer for that matter. Katika balance sheet, katika statement of financial position, mbona hatufanyi time apportionment? Only parent company? No. That's not the reason. John Dungu, no. Give me a minute, I change my battery. Thank you so much. So these guys have already answered the question very well. Wametuambia kwamba what those students have told us, which is very, very important, is that for financial position, whatever figures you are seeing here, including the figures of the subsidiary, are the figures which existed at the reporting date. You know, for the income statement, we say income statement for the year ended, a whole year. So those figures, if it says they are accruing daily, monthly, like that. Okay, great. No problem, Jimmy. Great. So for us, ladies and gentlemen, what we're supposed to know is that for the statement of financial position, we don't do time apportionment. Are there things you'd want me to add here? Are there things you'd want me to add here? Are there things you'd want me to add? There are things I told you guys. There are things I told you guys. There are things I told you guys to note. Before depreciation, we have the revaluation. There is a revaluation upward of what here, somebody? 2,000 minus depreciation of 200. Yeah, there was a revaluation upward. Goodwill, I'll come back to this later. Working. I'll come back to this later. So we come to current assets. Yes, we come to current assets. So current assets, what do we have? By the way, kwanza usifanye kwanza adjustments. Wewe kwanza shikanisha tu. So kama current asset kuna 16,000. Current asset kuna 16,000. 16,000 plus 6,600. Plus 6,600. Right? Enda kwa next one. Next one is share capital. So for share capital, what do you know about share capital? What do you know about share capital? Share capital. What do you know about share capital? What do you know about share capital? One of the, we shall only take one only, the parent figure. So share capital, we shall take the one of the parent only. Haya, parent only. Tuachana nayo kwanza namna hiyo. Mzazi peke yake, thank you very much. Retained earnings inahitaji working. Inahitaji working. Retained earnings inahitaji working. Unaweka namna hiyo. Na controlling interest pia inahitaji working. Unachana nayo namna hiyo. Haya, tuko na 10% loan notes. So 10% loan notes, what do we have here? 10% loan notes. 10% loan notes, I can see 3,000 plus 4,000. 3,000 plus 4,000. 3,000 plus 4,000. And then I can see current liabilities, free marks really. I can see current liabilities. So current liabilities, what do we have for current liabilities? 8,200 and 4,700. 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 So tunaanza na adjustment sasa. Na adjustment hapa tazikuangi noma. Najua adjustment kwa balance sheet ni gani sasa? Mwanzo kabisa najua the first one ni your revaluation vis-a-vis what its depreciation that are finished. Next adjustment ni internal owings. Internal owings, call them intra owings. So internal owings, are you able to see these internal owings? Are you able to see these internal owings in this question? Are you able to see the internal owings? Oh, yes. If you read this very well, what are they telling us, ladies and gentlemen, here? They're telling us here, sophistic trade receivables as at 30th September 08, it includes 600,000 due from pedantic. That is a fake receivable. That is a fake receivable. 600,000 we are expecting to receive from our subsidiary. Just like I told you the other time, if today I was to give my wife 100,000 Kenya shillings, my wife is a serious relative. Honestly speaking, even if I gave her on her promise that she'll give me back that money, do you think she'll ever give me that? Will she ever give me back that money? Do I expect to be ever to be paid back the money? No. Haiwezekani. There is no chance, yes. There's no chance, yes. But lakini sasa zingine hata wasichana mkona mnatuumiza sana. Imagine kama ni mimi nilikuwa nimemuomba. Kama ni mimi nilimuomba 100,000. Kama mimi nilimuomba 100,000. What do you think will happen? Sema utalipa. Boy child na kuna shida. Kwanza plus interest, unaona? Sababu atakwambia Mary amesema atakwambia hii pesa ni ya chama. Hii pesa ni ya chama. Anakwambia amekopa ya. We shall overcome. That's how human beings we are. So here tumeambiwa kwamba kuna receivable which has a problem. So this receivable 600, where should I adjust this 600 at? Where should I adjust this 600 from? Because it's a fake receivable. Pedantic has a policy, no. Sophistic trade receivable as of 30th September 08 includes 600 due from pedantic. So where should I, of course, subtract? Please talk to me in this. I need to deduct that 600 from receivable and pay. No, first from a receivable, and receivables are found in current assets, isn't it? So amesema kwanza from receivable, so nasema minus 600. Thank you very much. 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 Ladies and gentlemen, from there, what else are they telling us? Unaendelea kusoma statement. Ukiendelea kusoma hapo mbele naambiwa it includes 600 due from pedantic which did not agree with the pedantic's corresponding trade payable. This was due to cash in transit of 200,000. So this cash in transit is a free mark, which I'll always get cash in transit. Cash in transit, one company has already paid money. It's on the way. So already the company has released the money. This other company on their side has not received the money, has not adjusted the books. But you see the eyes of the group are big. It's able to see all those vehicles moving around with our assets around. So cash in transit, it is either you add it here or you can even come under always. It's a free mark. Upper we introduce what we call cash in the assets. Usema to cash in transit. Cash in transit. We'll come a different asset. No worry. 200. Cash in transit. Cash in transit. 200. Cash in transit. CIT. CIT. Tusome tena hiyo kitu rahisi, una pause tu hizi vitu. Hakuna kitu rahisi kama group consolidation. Group consolidation ifai kukushtua. Hiyo ifai kukushtua at all. Hiyo ifai kukushtua at all. So, and gentlemen, we are told here, due from pedantic, which do not agree with the pedantic corresponding trade payable. This was due to cash in transit of 200,000 from pedantic to sophistic. So, Norizeni swali, according to pedantic, what is their payable? What is their payable to sophistic? What is their payable to sophistic? Remember, initially, they had a payable of how much? And then they released 200,000. They're not following. 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 They are not following. They are not following. Kumuka, initially, these guys owed sophistic a whole 600,000. But then they have already dispatched some $200,000 dollars is on the way. So it means that they must have written down their payable by that 200,000. So according to them, the intra payable is supposed to be 400. But even that intra payable is fake. It's fake. That intra payable is fake. Where am I supposed to subtract it from, that intra payable? 400. Remember, initially it was like this. In terms of receivable, we had sophistic receivable, 600. We had the pedantic payable, 600. But you see, pedantic has already paid 200. It's on the way. Of course, the moment they released their check, they must have reduced that payable. Intra-payable of 400 to be subtracted from liabilities. So current liabilities here, you say minus what here, somebody? You say minus 400. You say minus 400 like that. You say minus 400 like that. Great. Thank you so much. Thank you so much. Thank you so much. So could you be kind to me and give me the property, plant, and equipment figure? Please give me the PPE figure. Give me the PPE figure. Paul Ogero, good dance, but why are you using a lady to dance? And you're a man, Paul Ogero. Yes, Steve, please talk to me. URP. URP, yes. Kwa inventory, thank you very much. Kwa inventory, thank you very much. Kuna UPS. Mimi naita UPS wewe. Nyinyi mnafunza na walimu wangapi? Mimi naita UPS. Unrealized profit tungesahau. Unaona tungesahau. UPS. Ilikuwa ya ngapi? Ilikuwa ya shilingi 100 ngapi? UPS ilikuwa ya shilingi 100 ngapi? Shilingi 800. Tukasema namna gani katika, of course, katika inventory is in current assets, eh? So katika current assets lazima kuja nisifanya namna gani? Nisema minus 800. Thank you so much for that. Lakini ningekuwa na karatasi yangu singesahau because hiyo na note tu chini. Sawa sawa. So every current assets and gentlemen zinakuja ngapi hapa? Brakadabra niandike hapa. Current assets zinakuja ngapi? According to Betty, 55,000. Betty amesema 55,000. How about PPE? PPE ilikuwa inakuja ngapi oye? PPE ilikuwa inakuja ngapi? Oh, into 55,000 PPE, eh? No worries. No worries. How about, in this case, your current assets then? How about current assets? How about current assets? How about current assets? How about current assets? 21,200. Current assets are 21,200. Thank you so much. Cash in transit, already we have that one. Share capital, I'll give you a figure. Retained earnings, I'll give you a figure. Non-controlling interest. Non-controlling interest, there is a working needed. Then we have 10% loan notes. 10% loan notes. What do we have here for 10% loan notes? 10% loan notes in Maxia Bure, yeah, 7,000. 10% loan notes, 7,000. How about the last one, current liabilities? What do we have here for current liabilities? The last one now. The last one now, current liabilities. How much do we have there as current liabilities? 12,500. Thank you very much. Sasa, hii swali hata ukiwaachia hapa, as I showed you, utaona kasi nile mesema any 6, wanakupatia mark yo, wanapenda kitu ya any 6, unapata mark yote 100%, and yet you've left so many things without having worked them out. Unaona mark unasema any 6, 1, 2, 3, unapata full marks for that question. And don't go low hanging fruits, but I'll be showing you that towards the end of what year? The semester. For now, let's learn. For now, let's learn. Ladies and gentlemen, I will have to wrap this to introduce something very important. I would want us to introduce something very important. Of course, you guys have figures. So now I want to work out the figures that are missing here. Great. So first of all, up to here, are we together, all of us? Are we together, all of us, up to here? Are we together, all of us, up to here? Are we together, all of us, up to here? Are we together, all of us, up to here? Are we together, Steve? Yes. Only one person confirming yes. Betty, yes. Yes. John Dungu, yes. Thank you so much. Thank you so much. Great. Thank you so much. Now, ladies and gentlemen, from there, I will straight away now look for the other figures in the balance sheet. Balance sheet. Balance sheet has some workings that we need. Now, for me to be able to give you the figures of the balance sheet, there are workings that I need here now. Workings for the statement of financial position. Of which, first of all, I'll come and look for the net assets of the subsidiary. The subsidiary which I'm acquiring. So I would want net assets at acquisition and at reporting. These two, at acquisition and at reporting. Haya, please ukiandika pakavo, ukiandika weka thumbs up. Weka thumbs up, niambie hapo sasa tuko sawa sawa. Weka thumbs up, niambie hapo sasa tuko sawa sawa. Weka thumbs up, niambie tumeandika paka hapo. Weka thumbs up, uniambie tumeandika paka hapo. Jimmy Kigo, yes. This is at acquisition. And then thank you very much. Now, thank you very much. Ukisikia hata kuele swali tulikuwa tumefanya jana ya Advanced FM. Ukisikia net assets, what comes to your mind? Mimi nikisikia net assets, najua wanaongea kuhusu nini? Equity. Always. Najua wakisema net assets ni equity. Thank you very much, Betty. Now, could you kindly give me the components of equity that you guys are aware of? You guys are accountants. You guys are accountants. When they talk of equity, there are those equity elements. There are those equity elements. There are those equity elements. Are you able to remember them? Are you able to remember? Share capital Nimrod. Thank you very much. We have the share capital. Share capital is one of them. Thank you very much. Any other? Retained earnings. Before that, kuna kitu inaitwa share premium, isn't it? Okay, kwa hii question hakuna, lakini kuna kuwa na share premium. It's good to just put it there. Kuna revaluations. We don't call them revaluations here. General reserve, yes. General reserve, yes, but I'll not put it here. Great. Fair value. So we have what we call fair value adjustment. Denominator evaluation, fair value adjustment. And even before that, retained earnings, isn't it? Upper. Retained earnings, alafu fair value adjustment, alafu depreciation of fair value. Depreciation of on. Thank you very much. Abracadabra, ebu angalia subsidiary yako, unipatie share capital. abracadabra, angalia subsidiary yako. Angalia subsidiary yako. Angalia subsidiary yako jameni. Angalia subsidiary yako jameni. Uweze kunipatia share capital. Sasa utapata Saturn anakuambia ati share capital ati ni 10,000. Mbona umetoa 10,000? Hii 10 ya parent bwana. Share capital ya Sophistic hapa ni 4,000. So unazikopi hapa at reporting, share capital ni 4,000. Oh yeah. Share premium pale hakuna. Retained earnings at reporting. Nasoma retained earnings at reporting. Retained earnings at reporting ni 6,500. 6,500. Haya. Nipatini fair value. Mnakumbuka fair value adjustment? Mnakumbuka revaluation? Mnakumbuka revaluation? Oh yeah. Mnakumbuka revaluation? Oh yeah. Revaluation? Oh yeah. Revaluation ilikuwa ya ngapi? 2,000. Niko peke yangu lakini I will overcome. So niko na revaluation. Hii fair value adjustment hapa naweka 2,000 hapa. Oh yeah. 2,000. Na pia depreciation of the fair value adjustment. Hii mlikuwa mmeshapata. Ngapi? Kwa unakumbuka 2 ama ilikuwa ngapi? Depreciation on the revaluation. Depreciation on the revaluation. 2, isn't it? 2. Thank you very much. Aya, abracadabra. Najua share capital ni the same. Share capital at acquisition na share capital at reporting ni the same. Inaweka 4,000. Hata share premium wanga the same. Retained earnings hii jamani lazima nikuwe na kawaking kidogo. Fair value adjustment the same. 2,000 the same. Depreciation of fair value adjustment at acquisition hakuna. Depreciation normally starts with what year? With 0. So this is the only working that I need. This is the only working that I need. This is the only working that I need. Retained earnings at acquisition. Examiner wengi atakupatia direct. Lakini pia wengi hawawezi. Retained earnings at acquisition. Hii ni abracadabra. Mimi nimeshamaliza haraka. Kwanza tukubaliana nyinyi tuko pamoja kweli? Isifike maana naanza kujiongelesha peke yangu. Tuko pamoja kweli paka hapa kweli? Tuko pamoja kweli? Oh yeah. Betty amesema yes. Aha. Lucy, yes. Thank you very much. Stevie, yes. 3 out of 51. I'm so sure hapa lazima kuna mwanafunzi analala na huwezi kumblame. Sababu leo mwalimu hana story. Sasa zina stories zinasaidia. Kile hatuna story kusema ukweli kabisa. Thank you much Bwana Okewa. This is a very serious subject. Haitaki story sana. Aya, sasa tumeona retained earnings at reporting ilikuwa ni ngapi? Somebody ilikuwa ni 6,500. Sasa hawa jamani wazuri sana. What normally makes our retained earnings to grow? It is the profit of the year. Unaona profit of the year? Profit of the year inafanya retained earnings ina grow. Mimi napenda sana hii. Sasa nitakuja tena nimchoree number line. Unaona? Nimchoree number line. Nimchoree namna hii. Nimwambie retained earnings by the end of the year was 6,500. But the whole year retained earnings, profit for the year ilikuwa ni 3,000. And we stayed with this subsidiary for only 6 months. Meaning that profit for 6 months from here to here ilikuwa ni 1,500. Hiyo hawajaona profit for the year ya subsidiary. Hiyo nataka mwanafunzi akona macho sharp sana. Mbona hii ndio profit for the year ya subsidiary 3,000. Hii ndio profit for the year ya subsidiary 3,000. Hiyo 3,000. But remember, this is profit for a whole year. That's profit for a whole year, 3,000. And as we are in agreement that we stayed with this subsidiary for how many months? 6 months. So profit from here, this is the date of acquisition. To date of financial reports, financial statements. We stayed with this thing for 6 months. And during the 6 months, ladies and gentlemen, we only generated 1,500 that went in as retained earnings. There is nowhere these guys have told us that dividends were paid. Nowhere. So the whole of this amount went here. The whole of this amount is inside. So when I work back retrospectively, then the retained earnings at acquisition, retained earnings at acquisition, retained earnings at acquisition will be this 6,500 minus 1,500, which gives us 5,000. Because we wanted retained earnings at acquisition. Remember, what feeds into retained earnings are the profits that we get. Over the 6 months period, we generated a profit of how much? 1,500. The whole of which that went where? The whole of which that went into the retained earnings. So I would want to work back and ask myself where we got the 3,000 from. David is asking where we got the 3,000 from. It's here. Sophistic profit for the year, 3,000. Sophistic for the 6 months, it made a profit of 3,000. And as we know that we stayed with it for only 6 months. So 3,000 times 6 over 12 gives me 1,500. I'm so sure that some of these things will make sense as we progress, as we progress. So can we go to something different, my friends? My friends, can we go to something different? Can we go to something different? Can we go to the next step? Is it possible for you to give me the totals? Is it possible for you to give me the totals? So give me the total here. At acquisition, what is the net asset value at acquisition? Net asset value at acquisition. Net assets, total net assets, total net assets, total net assets. Numero nembeni 11,000 hapa. 11,000. Thank you very much. Right. How about net assets at reporting? $12,300. Thank you very much. $12,300. Thank you very much. Now you can see our net assets grew. When your net assets grow like that, then we talk of post-acquisition profit. So we have what we call the famous POP. The famous POP. The post-acquisition profit. Post-acquisition profit. Please write this in full. The famous POP. The growth in net assets is called POP. So the growth in net assets here will be 12,300 minus 11,000. This will end up giving us what figure, somebody? 12,300 minus 11,000 will end up giving us how much? 1,300. So what do we do with this POP? What do we do with this POP? What do we do with the POP? Who can remind us? It has got 2 owners. POP has got 2 owners. It must be shared out between the 2 owners. So share the POP. Share the POP. Share the POP. We have here 1,300 to be shared out to the parent. Who can remind us what is the percentage of the parent? What is the percentage of the parent? What is the percentage of the parent? 60%. So the parent will take 60%, and then we have the non-controlling interest taking the other percentage, which is 40%. Which is 40%. So could you kindly give me this figure? If the parent takes 60% of 1,300, the parent will take how much? The parent will take how much? The parent takes 780, and then NCI will take how much here, somebody? NCI will take 40%. NCI will take 520. So when you get POP, which is the growth in your net assets, remember to share POP immediately. remember to share POP immediately. Remember to share POP immediately between the two owners of the subsidiary. Now, once you have done that, I know that my next working now here will be the NCI working. So mention there, NCI. Mention there, NCI working. NCI working. So the NCI. So NCI working, ladies and gentlemen, I'm interested in the NCI at acquisition. So NCI at acquisition, this will be given in the last notes normally. Down there, the last notes, they'll tell you that NCI at acquisition, NCI at acquisition, NCI at acquisition, NCI at acquisition, watakuambia mahali hapo chini. NCI at acquisition, ndokuambia hapa, Pedantic has a policy of accounting for any NCI interest at fair value. Fair value of the NCI at acquisition was 5,900. At acquisition was 5,900. At acquisition was 5,900. Great, 5,900. Great, 5,900. So kuja hapa, sema NCI at acquisition is 5,900. 5,900. Come here and add share of POP. Share of what here? POP. Add share of POP. Do you remember the share of POP? Do you remember the share of POP that you guys gave me up there, NCI? 500 what here? 520. 520. And then later on, we shall bring in their share of what here? Impaired goodwill. The impairment in goodwill later on. So, ladies and gentlemen, I feel that I've covered more than enough for the lesson. I would want a few minutes on Wednesday to complete the entire, but I believe we have covered so much in one lesson. In one lesson, we must have covered so much. You know, so as a teacher, I have that feeling. I have that feeling that hiyo tumefanya. Hata kama nataka kumaliza. At least tumewakumbusha. Tukija kwa next lesson sana kufanya kidogo goodwill, we clear this thing. So otherwise, thank you very much. For the very new students that I'm giving this lesson for free, please don't forget to register with RCM. Yuko wanafunzi ambao wanapenda kutapatapa, amesoma hii semester hapa, next semester nataka kusoma wapi? Hapana. We are a sure bet. I'm so sure most of you mmeshafunzwa na walimu wengi sana consolidation, and this is an approach perhaps you have never seen anywhere else. It's an approach ambayo ni direct, haina mambo ya T accounts. So please, this is the place to be. So for the new students, don't forget please to call our numbers. These are our numbers. Get in touch with us. Through WhatsApp. We give you information, we survive. And remember, for those of you who may not be having money simply because the date is not very favorable, just pay some commitment fee and then do a promise to pay next month around 5th, 6th. Remember, it's about you. It's really about you. It's not about us. Otherwise, thank you very much. I can now see Obadia Kirui has become an expert. Mara kwanza Obadia alikuwa anaogopa sana class online. Sasa Obadia, I can see you are the one saying thank you. Actually, you should even talk to me immediately after this on WhatsApp, Obadia. Thank you very much. Good night. We shall discuss